Okay, so buckle up. We're going to cover a lot of things right now, including a little bit of alphabet soup. But what I want Bill to do is kind of take us through the whole loan process from start to finish, from the time the borrower calls up on the phone and says, "I want to borrow a loan," to when they get their payment statement in the mail. So kind of.
Okay, so we'll
So
start.
that's all,
That's
Bill.
easy.
Just do
Piece of
that.
cake, no problem. I got this. I got this.
You got this.
So, anyways, essentially, borrower calls up on the phone. Hey, like to get a loan, buy a house. What we first do is fill out an application. Once we fill out an application, and that's typically done
which we
online.
call a 1003.
It's a 1003, and that's usually done online. Whether the borrower does it online prior to calling us, or we do it online when we have them on the phone. During that, we request a copy of their credit. So one of the things we were talking about earlier is we look at it from an acronym, another one, AlphabetSoup, CIA, Credit Income Assets. That's our internal way of looking at it. And those are the three components of qualifying.
So for the students out there, just stop right there and write down CIA, because those, we'll say it in different ways, but that's exactly, this is real life. This is credit, income, assets.
And those are the three basic components of trying to get a loan.
You got to have the right mix of that and the right.
Correct.
Each one, you have to have a little bit of all of them. You can't just have great assets but no credit, no income.
It's like a three-legged stool. If you don't have one of them,
you're falling over.
You're not going to get a loan. So you do have to have. You could have a shorter leg stool, and it might be a little unbalanced,
wonky,
but you have to have all three. But so they go through the application, we look at their credit. On the application, it tells us where they work or what source of income they have. Also on there, it tells us the assets that they have, where their monies are for the down payment, what they're doing to make the down payment. It tells us other assets such as house that they may have or cars or whatever. And then it gives us essentially just basic information in regards to their ethnicity, their just the basic information that we can't qualify, or that there's no discrimination.
So, and to go a little deeper in the 1003, if someone owns some rental properties, it's going to identify the rental properties out there, and of course the key is income, and then also is kind of the what your bills are.
Yeah, so there's what's called debt to income. So if we look at credit first, credit income assets. So credit first, we generally would like to see a credit score of minimum 620 for a conforming loan amount. Fannie Mae, Freddie Mac, FHA will go to 580, and we'll find out what your payment history is. The best type of interest rate you'll get is if it's around 740. Some are 760, but 740 is a good area to shoot for. So we'll try and figure that out. If there needs to be tweaks to that credit, we'll go through a credit simulator, have them adjust. Well, if you pay this balance down, if you do this balance over here, we'll see it could make a difference in their credit score. And sometimes credit score can make or break where they go. So that's credit. Income, there's all sorts of different income avenues that are out there. There's employment income, standard W-2, there's self-employment, there's retirement, there's Social Security, there's rental income, there's disability, there's unemployment. You can actually
qualify for loan unemployment.
If they're like seasonal unemployment, you can use that. So there's interest income, dividend income, there's all sorts of different income that can be used for qualifying. So we just have to make sure that we have the right information to understand what those income sources are. Usually that means W-2s and tax returns. So we'll gather those two things to determine income.
So go off a little bit on people that are self-employed, 1090. Well, first, W-2 people who also get bonuses, and then 1099 people who file a Schedule C.
There's Schedule C, and usually it could be a corporate return.
Corporate. Well, let's just
LLC.
Let's just say it's a 1099 person who is writes off. So
so we generally look at so if it's a W-2 employee and they've been working for they've shown a history of work, say probably 6 months or so, somewhere in there, or they've had schooling for that. you can use it right away. W-2 income, no problem. If you're self-employed, which would be 1099 income, that's considered self-employed, we would need 2 years history of that. It's kind of the 2-year rule. If you're using 2 years of bonus, or if you have bonus, you have to have 2 years of bonus to use. If you get commission, 2 years of commission. If you're 1099, 2 years of history on 1099. Now 1099, what ends up happening a lot is they pay you money and you say, well, this is how much I make. And we look at the tax return and we go, no, that's not how much you make. It's a lot less, because 1099 will write off a lot of expenses. They'll write off their car, their office at their home,
everything they can.
This and that and the other thing, expenses for meals and entertainment and clothing and whatever it is. So we, as originators and mortgage industry, looks at the net. There's the gross and then there's the net. And we look at the net income.
So it's not uncommon that someone goes, hey, I make all this money, and then the lender looks at that and, or they just know it ahead of time. They go, listen, I make really good money and I can afford this. However, I'm pretty aggressive on what I write off. Well, it's live by the sword, die by the sword. Yeah, you're going to pay a lot less taxes, and you're going to qualify for a lot less of a house.
Correct.
Ultimately, or you're going to go outside of conforming and go to
pay a higher interest rate,
a non-QM loan, as we talked about before, that says, we get you, wink, wink, nod, nod, we get it. We'll make the loan, but if it's 5% now, you're going to pay 6%, or 7 or 8, or whatever that market's going to bear. So
we got that income. So you want me to go to the assets?
Got that. Yeah, let's talk about assets.
So assets is the third leg to the stool, and that is basically money for a down payment. It's cash, or it's your checking account, savings account. Maybe you have stocks. Maybe you're taking money from a 401k or an IRA. You may be getting gift funds from a family member. So it's really trying to verify what assets you have for the down payment. Is it enough for what they're trying to qualify for? Do they have to put more money down in order to get their mortgage payment to within a debt to income ratio that's allowable?
Right.
So there's a lot of variances. So those are the three components: credit, income, assets, and then you just kind of mold that together. Once we gather all that information, we then move it into processing. And so the processor then makes sure that all the I's are dotted, T's are crossed. We have the right bank statements, the right pay stubs. We have the right assets. Everything's ready to go. They bundle it up. They send it to an underwriter. And during processing, we will also typically order an appraisal. And I would say most loans still require an appraisal. And so we'll order the appraisal. It'll come back, and hopefully it'll come back at the sale price that they purchased it at, or higher. So then that gets packaged up, goes to the underwriter. The underwriter checks off, makes sure that all the information was accurate, the appraisal's okay, the income's okay. They're just kind of the last stop.
I always used to refer to underwriters as God with a small G.
they're like the Wizard of Oz behind the curtain.
They're behind the curtain.
Can't talk to them, But so once it goes through underwriting, there's typically a condition or two. The processor or the originator will call out the borrower and get that information that they may be missing to complete the file. Then it goes to closing, where they draw documents. They send the documents over to the title company, and then the title company has the client come in, sign documents, send back to the mortgage company. We send a bunch of money to the title company, and then it funds and close, and then they become homeowners. Sounds easy, right?
Yeah.
So it's a piece of cake.
So one of the documents in with the documents is actually your first payment, and then a couple weeks later you send them a payment booklet or some version of payment.
Yeah, most everything's online now.
It's on that. So in previous chapters we talked about some of the AlphabetSoup.
Yep.
So I want to kind of go back over what you've just done and kind of pick out where some of these AlphabetSoup fit into that. So first, let's talk about RESPA quickly. RESPA is Real Estate Settlement Procedures Act, and that whenever we say RESPA, each of us has a different thought about RESPA. Your first thought is?
My first thought is that we cannot give you money to give us loans. We can't do referrals. It's got to be very straightforward. Nothing of value could go to Kevin for him to refer us loans.
So if I have a borrower, send them over to Bill. I can't go, Bill, hit me up like this, because that's not even close to being. It's just
you can't do that.
Don't do that. Similarly, so on the real estate side of things, this is also when we get into the topic, and I just had this week with a young man on the topic of referral fees. So I can pay a referral fee to another broker, but I just can't pay them to an individual who's out there working like a bird dog for me, who's trying to stir up business my way and sends, if I give him money, that's a violation. Well, it is and it isn't. It is if a federally chartered loan is involved, which is any Fannie Mae, Freddie Mac loan is going to be that. But if it was an all cash deal under the state of California, it's not illegal. So it's funny, different there. But my version of it is err to the side of
caution.
Caution.
Sure, right?
It's not worth.
Not worth it.
Yeah, I do not want to sit in jail one day and have some big ugly guy look at me and go, "What are you in for?" I go, "Yeah, I paid a referral fee to someone who was unlicensed." I don't want that experience.
It's not good.
Okay, so that's RESPA. So Real Estate Settlement Procedures Act also gives us a lot of the rules of how we're going to settle this loan. Years ago, we used to generate something called a HUD-1, which was a closing statement. Usually, escrow would produce this, and part of the Dodd-Frank changeover put that a lot of things into the lender's bailiwick, starting with at the application. So I come in and you take my loan.
Yeah.
What's the timeline? You got to do something within a certain number of days, right?
Yeah. So there's what's called a loan estimate. So we talk about it. You talk about the loan program, what you'd like, and we would do a loan estimate, and that has to be delivered to you within 3 days of application.
Right.
So if you're applying for a 30-year fixed rate mortgage, I would provide you with a loan estimate for a 30-year fixed rate mortgage, and it would spell out the cost, the interest rate, all that stuff. And that's a good thing because you can use that to shop for the mortgage.
Apples with apples.
Apples to apples, and they really put a lot of work into the LE. We call it LE for short, the Alphabet Soup.
Because we
loan
love
estimate,
we love our acronyms.
But it really is detailed, and it's much easier to compare loans than before.
Yeah, back in the old days, the closest we had was APR, which nobody calculated APR the same way, and you could fudge this way or fudge that way, and people would. So the other thing that happens, I mentioned this in previous episode, is that when it gets down to the documents that you're part of the documents that you're getting a closing disclosure, right?
It's called a CD.
CD, of course.
Closing disclosure, and that has to be generated 3 days prior to closing. So that the client can take a look at it and say, okay, these are the terms that I agreed to. I have the ability to change if I want. And then it also has to match up with the LE based on the variances that are allowed.
And just to go back a little bit to the loan estimate for the students in the class that are looking to become real estate agents, you're probably going to point that transaction to a certain escrow company or certain title company that's part of your team that's working with you, part of your success. One of the big delays that I always see happen in the early days of an escrow is escrow or title is slow getting the cost because they've got to generate this closing estimate based off of numbers that are given them. So they could be sitting here waiting for 1 or 2 numbers and can't hit print because they're waiting for that. So always stress to your escrow and title people, give me the numbers right away. So just a quick little thing. And then at the end, though, you also generate a closing statement. What we used to call a HUD-1 is generating through the lender.
CD.
The CD is the closing.
CD
is the closing statement.
Acting as a closing.
As acting.
But it's interesting, Kevin, because they still will provide you a closing statement that looked like the HUD-1.
Okay, good.
Because it was so entrenched in the real estate industry. But it's just as a courtesy.
Oh, okay, because I know that for for years, I mean, whenever I've bought or sold real estate, I've always, where's
And
that?
you're used to that, right?
Well, I'm
You've
just used to
seen it, you
take
understand it,
that,
yeah.
and because I just give it to my tax person and say,
Yeah.
you figure this
Here
out.
you go.
What happened? What you figure this out.
Yeah.
So couple quick little notes I thought about. One is when Bill was talking about the assets that you're going to liquidate in order to buy, keep in mind some of those aren't liquid for 5 days or 30 days. Like if you're getting money out of a 401k, each company is different. So you need to know what they are so that you can get it out in time. Also, if you're selling stocks, and stocks are here day 1 of the escrow, and they're there day 30 of the escrow, and wait a second, I needed all that to be able to qualify. So when you're going to commit, you want to generally speaking, you want to liquidate those as soon as possible so you don't get surprises. And yes, we've lost deals because people waited too long and they just didn't have the money for the down payment.
Yeah. But we've also had the other side too, where we said liquidate, and then for some reason they fall out of escrow for a different reason, and they shouldn't have liquidated.
Yeah, also
they
walked away from
So it's a balance.
And remember too is that when you liquidate those assets, there could be a tax consequence on your next tax
capital
filing.
Gains,
that the capital gains that you need to factor in. It's not all your money. The government wants
a piece.
Is going to want their piece of it too. Talk a little bit about gifts.
So gift funds are actually very typical, where family members will provide gifts to other family members for the down payment.
Mm-hmm.
Usually it may be mom and dad gifting monies to a child.
Right.
They can both gift certain amounts and not run into any like estate issues. But there's there's some stuff there. But it has to be a family member or someone close.
Yeah. So it can't be the seller. That's not allowed.
No.
And again, it's not.
But it can be an aunt, an uncle. We've seen it as fiancés.
Right.
So it has to be very family oriented.
Yeah. And so they issue a gift letter that basically is saying, I give this out of the love in my heart versus getting paid back. There's no expectation of getting paid back.
As long as you invite me to the next barbecue.
Exactly, yeah. Because otherwise, there may be understandings around the barn about the door around that, like, no kidding, kid, you're paying me that back,
right.
But I'll sign that. But gift funds are, and in fact, this young man I was having coffee with, this other young man I was talking to, I was like, well, you got no money. Who do you know who's got some money? Can you get a gift?
It can help. I mean, it happens all the time.
How I bought my first house. How I bought my second house was good.
Yeah. And it can sometimes happen out of just the family member not even knowing. Like, I'm thinking about buying a house. Oh, well, I'll give you a gift.
Yeah.
And you just don't know. So that happens quite a bit.
Totally worth it. Or the young man that we're working with right now, Trevor's working with, and parents say, you need to buy something and we'll give you the down payment. He's got like 30% down to buy. And
wouldn't that be nice?
It's just like, dude,
wake better
up.
Parents.
You need, dude, wake up and go and go shopping.
That's right.
Now.
That's
so,
right.
All right. Well, thank you very much.